Growth investing is a very popular investment strategy and one that's recommended by Dave Ramsey. What exactly is growth investing and how does it compare to others? Is this a strategy that you should be implementing? Taking advantage of the investment strategy that makes the most sense for you can mean the difference of hundreds of thousands or even millions of dollars by the time you retire. It's common for people to ignore the type of their investments, particularly when they're held in a 401k. It's a set it and forget it mentality. Sometimes, they might not even know what they're invested in or how their returns compare to the overall market. Take a look at the advantages and disadvantages of a growth strategy so you don't end up leaving millions of dollars on the table. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. What is growth investing? Growth investing is a strategy focused on capital appreciation and future earning potential of a company. Investors typically look for high-quality, established companies that have a history of high growth and are likely to continue growing at a rapid rate. Using a combination of fundamentals and other factors, investors make a prediction for the future. A company like Amazon has grown at a rapid rate for a relatively long time. Since it was founded in 1994, it's grown to the world's fourth largest company by market cap. Although the chances of it continuing to grow at the same rate it has previously are low due to its massive size, investors can predict that it will still continue growing reasonably fast. Take a look at Walmart, which is a much older company founded in 1962, and you can see how growth has slowed because it's become so large. Once there's a Walmart in almost every town, there's only so much more they can do to increase profits. Returns are generally higher. The single largest advantage to a growth investing strategy is the high returns. Earning great money is the point of investing, right? Over a long period of time, growth investors are generally able to outpace the returns of broad market funds and even those like the S&P 500, for example. This presents a fantastic opportunity for younger people who have smaller portfolios that are focused on increasing their nest egg as opposed to preserving their capital. If you have $10,000, you're probably not too concerned about losing it, but you are focused on how you can get it to grow quickly. As investors age, they become less concerned with their returns and stability becomes more of a priority. When someone amasses a multi-million-dollar portfolio, their priority usually becomes capital preservation. This is the reason many older people put a significant percentage of their savings into bonds, which are more stable but provide small returns. Risk is generally higher. Of course, it should come as no surprise that higher reward typically means higher risk. No one wants to put their hard-earned money in high-risk investments that could shrivel up to nothing. The good news is that over the long term, the higher risk will be in your favor as long as you choose quality investments. It's extremely common for novice investors to get spooked when the stock market drops. They see selling as a way to limit their losses, when in reality, chances are that it's already too late by the time they sell, and they could very well be doing so at the bottom. If you're able to tolerate market fluctuations without the temptation to sell when things are red, history shows that you'll be rewarded. This is much easier to do the younger you are, but becomes less tolerable as you age. A 50% drop or more in portfolio value for someone in their 20s and 30s would likely have no impact on their day-to-day lives. Since the average retirement savings of someone 30 to 34 years of age is just under $22,000, that would only mean a dip of $11,000. Someone nearing retirement or who was already retired would probably want to avoid swings that extreme at all costs. Could you imagine stomaching a $1 million or more dip in your retirement savings? There are little to no dividends. Growth investments pay little to no income, which is a disadvantage in the eyes of many investors. The reason there are little to no dividends is because the companies choose to reinvest their profits by continuing to grow the business. Some companies pay high dividends because they feel that they can no longer reinvest the entirety of the profits within the business. Instead, it's better distributed to shareholders. That's one reason why dividend and income-paying stocks tend to grow at lower rates. Just like Walmart's growth has slowed, so has the growth of many dividend stocks. Some investors prefer that the company keep the profits and invest it themselves, instead of receiving dividend payments and having to choose whether to buy more shares or invest it elsewhere. Why would they want to receive cash when the company could reinvest it wisely? You could reinvest the dividends manually or by utilizing a dividend reinvestment plan, but it's not the same as the company's board of directors focusing on growth. When a company begins paying a dividend, it's seen as a plateau in growth. On the other hand, dividends can attract new investors, and dividends keep shareholders content during times of flat or even declining stock price. Growth stocks will provide much more money at retirement. What's really shocking when it comes to growth investing is the difference in the amount of money you could end up with. Over a career of investing, just a 1 or 2% difference in your overall returns can be shocking. Take, for example, someone who begins to invest in their mid-20s with $1,000. If they invest an additional $6,000 per year until retirement, or for about 40 years, and achieve an 8% annual rate of return, they'll have just over $1.7 million. For reference, the S&P 500 has an average rate of return of 10% per year over many decades. Now, if they were able to earn a higher rate of return by investing in high-growth alternatives and earn a 12% return for the same time period, investing the same amount of money, they would have a staggering $5,247,000. That difference of $3,547,000 could allow you to live a much different lifestyle during retirement. In fact, it would provide about 3 times the amount of retirement income. Consider that an individual earning $60,000 per year for 40 years will only earn $2.4 million before tax. While returns vary, and many would argue that 12% isn't achievable, the point is that the returns make an astronomical difference. Commonly, 401k investors might not even know what they're invested in, what their portfolio performance is, and how much it will impact them in the long run. They will gladly spend 40 hours or more per week working for $60,000 per year, but won't take the time to address their portfolio, which will have a greater financial impact on them in the long run. It doesn't have to be complicated. An example of a great growth ETF is the Vanguard Growth ETF, or VUG. It holds large-cap U.S. companies similar to what you'd find in the S&P 500, except without slow-growing stocks. There are currently 287 holdings consisting of well-known names like Visa, Nvidia, and Home Depot. The average annual return of VUG over the past 10 years has been just under 18%, while Vanguard's S&P 500 ETF averaged just over 15% over the past 10 years. Growth has been better than the S&P 500, but the dividend yield is less than 0.5%. An index like this is an excellent approach for someone who wants to achieve a sizable amount of growth with a reasonable amount of stability. Growth investing is perhaps the best way to achieve great returns and compound your money over a long period of time. If you can handle any extra volatility, you will be rewarded. Don't leave money on the table by investing in funds that are too conservative for your timeline and goals. In the case of the previous modest example, it meant the difference of over $3.5 million. It's easy to get caught up with work, family, and other daily activities, but just a few minutes of going over your investments on occasion could mean a drastically different outcome in your financial future.